I hear a lot of people saying things that are contrary to what FEMA and National Flood Insurance Program representatives from Washington told us at that meeting. And all I can do is assume that what the people that are going to enforce the act told us is what they're going to do, not what I'm hearing on the street. And there are several PowerPoints out there. The one that's online right now at NER is not the one that we had at our meeting exactly. So I will try to get Tony as much information that I've got, and I've got some other information I can forward and PDFs that maybe they can disseminate to the members if they want it. It's not always easy to find. With the, a little bit of background, if y'all remember, realtors have been struggling for years over flood insurance premiums, flood insurance expiring, and then we had problems with closings because we couldn't do anything until Congress extended the flood insurance program. So for years we've been asking NER to lobby to have the flood insurance program extended more than short periods of time. Last year we had a call for action to extend it for 5 years, which we all celebrated. We participated in the call for action and we begged that it be approved. What we didn't realize was on the back end of what we were asking to be approved, changes were being negotiated to add the Bigger Waters Act to it. So we're calling our congressman saying we demand that you do this because it's critical to our coastal communities, and they're getting the bill with the additions that we didn't know were on it. So there was a little disconnect there in what we were asking them to do and what they did. With that though, it came and it passed July 6th. One thing we learned at the meeting in DC is it's retroactive basically, which the air came out of the room with the realtors in the meeting, because any houses we sold to people after July 6, 2012, their insurance renewals will now be increased. If they're one of those properties that will be increased, and we didn't tell them about it because we didn't know about it. The insurance industry did not know about it. When I found out in March of this year, I went to the insurance agent in the building where we have our office, and he didn't know about it, and went to his underwriters and talked to them, and they didn't know anything about it. And then they went online to FEMA and started researching and said, yeah, there's a webinar coming up to explain the recent changes made to FEMA and what's going to happen. And the flood insurance program, there are two different entities. So a lot of us didn't know, but that is something that we need to be aware of, is it goes back to July 7th or 6th, 2012 is when it takes effect. They said there was no delay built into the bill and the law, and when there's no delay built into it, it takes effect immediately. So just know that. I'm not going to go through all this. What we really are looking at is, well, the main reason they say they're doing it is because National Flood Insurance Premium Program is in a terrible deficit, which most things are. $24 billion. They had to borrow $9.7 billion after Sandy, and the problem has been in history. We've had catastrophic storms. There's been a deficit. We've had enough years that we could have premiums reimburse the fund before another catastrophic storm happened, and unfortunately we've had several within the past 5 or 6 years that have been pretty severe catastrophic storms. So it is at a deficit. If we have enough time to get back to not having 3 or 4 catastrophic storms in about 6 years, we can get the budget back to neutral. But that is the reason that they are saying they must do this, to raise more money. Who will be affected by the subsidy changes? There's a little misnomer there. It says not everyone, only 20% of the National Flood Insurance policies receive subsidies, and even smaller number will see immediate changes. On the graph they gave us, it shows about 19% of policyholders with subsidies, and that's a little over almost 1,100,000 properties, which if you read everything, they're saying there's not that many people affected, so it's for the greater good. Over 1 million properties, 1,100,000 properties at their latest count. I don't know how many people live in those or own those, but that's millions of people that it affects. So to me, that is a great amount of people and properties that are affected. It's not a minimal amount. The other thing is they're talking about on that 19%, it's all dealing with pre-firm, non-primary residents, pre-firm businesses, and pre-firm condos and multifamily properties. That's in the 1,000,001. They're not talking about in there the pre-firm primary residences that will be affected. And one thing that you need to remember is when they say that there's not that many people that are going to be affected, they're not considering someone being affected that is a primary residence pre-firm that their rates will not go up immediately because it is their primary residence. But according to the Act, when they sell that house and we go to closing with them, the new owner's insurance policy will be the actual rate of the risk of that property. Those people they don't think are being affected when their property values will diminish horrifically. But that's not, they say they're not being affected because they're only looking at people being affected as people that will have immediate increases to their flood insurance rates. And I would beg to differ with them that people that have their life savings in their properties or property they were going to sell for inheritance for their children or their families, when they look at what those premiums could be based on this Fair Waters Act and what that sales price will then come down to the value of the property, all of those people need to be added in here in this number because they are severely affected. Because at the point of sale, it goes up to the actual rate. So it is more than what you read. You need to read into it. The true meaning of this, as realtors, we know what happens, but you need to look into that. Owners of subsidized non-primary residences in special flood hazard areas will see a 25% increase annually until rates reflect true risk beginning January 1. There's a little difference too, and we've got to be aware of it. According to the IRS, a simple majority of the year is a principal residence. And I have a second home, and we thought about making my house on Tybee our principal residence to try to make sure we don't get hurt by this, because our house was built in 1958, 10 years before FEMA was even created, and it is pre-firm. With the Bigger Waters Act and what they just passed, to be a primary residence, you have to live there 80% of the year, or 292 days, which is approximately 10 months out of the year. So they're catching people on both ends. Most people could live, some people do live 6 months, even in your area and in Savannah. They live 6 months in Savannah and up north 6 months. Well, now for it to be a primary residence and protect themselves against this legislation, they would have to live in that home 10 months, basically, for it to be a primary residence, or they're not covered and protected by their current rates. So be sure when you quote people, primary and non-primary, that you read exactly what's in this bill or this law, because primary, what we're used to with IRS, is not the same as primary with the Bigger Waters Act. And we'll see 25% increases annually until the rates hit the actual risk rate. That's something that we're still searching for an exact answer, and I've had a lot of people work on that. I will tell you, they keep saying that there's not that many people, the rates aren't going that much. Jay Reinhardt was the 2009 president of the South Carolina Association of REALTORS the year I was president of GAR. He is an attorney by education, and his home, I talked to him last week, his home in South Carolina, 6 houses from the ocean. His insurance premium just came in last week. It was $1,500 a year, and it just went to $8,000 a year. That's an actual true statement. Y'all call Jay Reinhardt. But you keep hearing from the media and the government now and NAR, our association is saying, don't get excited, these really aren't true rates. Robin Lance's parents' rate went from $1,400 a year to $4,000 in Richmond Hill, Georgia. They are going up significantly, and we haven't even hit the actual, a lot of the changes are coming in and taking effect October 1st of this year. And so some people say, oh, it's safe, I got my renewal and I paid it. When their increase might not be coming into this October 1st revisions, and then some don't take effect until January of 14. So beware of what's happening. Also, HOAs right now are not included to a certain extent. And I did go up there and speak to them personally about that. But from what I've been told, and these gentlemen here might be able to tell you some more than the insurance agents, but we're being told that the HOAs will be included, and the condos, pre-firm condos that are below the BFE are going to see rates go up, and that means your HOA dues and those condos will go up. Also in South Carolina, because I have been working very closely with them, in South Carolina they've already had some lenders start refusing to make loans for condos on the beach because they're worried that when all this comes about with the condos and the HOA associations, that people will not be able to pay those HOA fees, and that the condos will go into foreclosure because they don't have the insurance. So they're already seeing mortgage lenders not making loans on condos, he said, in South Carolina. Now remember that what's mandated on this is government insured and backed loans have to have the flood insurance. Government insured and backed loans, Fannie Mae, Freddie Mac, FHA, VA. Because Florida has thought about self-insuring their state many times and having their own insurance, to which they said you would not be able to have any FHA, VA, or conventional loans that are insured or backed, because if we make loans in Florida, you must have insurance and it would be our insurance. So that's what signifies that you must have it. If your house is paid for, you can self-insure and not have insurance today. There is talk right now of forcing people that own their house free and clear to have the insurance at the rates, the actual rates, because they feel like it's only fair that even if you own your house free and clear, that you're in the pool and sharing the risk. So there is talk right now of trying to include, and I don't know if that will happen, but trying to include that. So just beware of that. As realtors, we need to know what also is the possibilities. But if it's your non-primary residence and it's built below the BFE, and that's one thing that we need to make sure, because don't get so excited, not every property, and that's what they're saying. If it's your non-primary residence and the base finished floor elevation is at 11 feet and you're at an AE 10 or AE 11 and you're 11.1 or something, your rate still is not going to be these 25%, 20% increases. The people that will really be harmed are the people that are pre-firm, that were older homes that are below the base floor, finished floor elevation is below the current flood mat minimum. Those are the people that will see the very high rates. So when you go out there, don't leave today telling everybody everybody's rates are going up in hysteria, like the first time we heard it, we thought. But I mean, it is a lot of people, and that's this 20% almost that they're saying are those people that are non-primary, pre-firm, pre-firm businesses, because it's commercial too, minimum. We're rated pre-firm, now they can pay actual rate for their insurance as well. So commercial property or commercial practitioner, same thing for you. If that finished floor elevation, the lowest finished floor elevation is below that flood mat minimum, they are going to see the 20%, 25% increases until it hits the actual rate. The question we keep saying is 25% of what? Jay Reinhardt was $1,500 and went to $8,000. So 25% of $1,500 is $375. That'd be $1,875. I don't know if it's 25% of what they feel like the actual rate's going to be at some day, or what that 25% is, because I don't compute $1,500 to $8,000 in any way at 25%. Owners of subsidized property that has experienced severe repetitive flood losses, they will also be affected whether you're pre-firm or not. So if you've had repetitive flood losses, you will be in there. Also, owners of subsidized business properties, a special flood hazard area we talked about, will see 25% rate increase annually until it hits true risk, beginning late 2013. That's the October 1st for the businesses. And owners of substantially damaged or substantially improved subsidized property will see a 25% rate increase. And that's pretty much, to a certain extent, already been there, that we always said if you were pre-firm and you added over 50% of the value to your property in additions or modifications, that you would then lose your pre-firm status, and that was there before this happened. So that's not a major change. The states at highest risk, according to them, are California, Texas, Louisiana, Florida, and New Jersey and New York, are on the map, the black states. They're the highest risk. Who won't be affected? Owners of primary residences, they say will keep their subsidized rates, and they do until their property, until you sell your property. Again, if you're a primary residence and you're pre-firm, you do get to keep that rate with normal increases annually until you sell it, and then it's released and the next owner goes at the current rate. Until you allow your policy to lapse, or you suffer severe repetitive flood losses, or you purchase a new policy after July 6th, which I think is very interesting, because if you have your policy now, basically what they've told the insurance companies is that if you change policies and get a new policy after July 6, 2012, you've released it. So I guess you can't shop policies to get a better rate, and the insurance companies can do whatever they want with their old policies, because you can't get a new policy, or you now will be at whatever rate you would go at. So that's another thing that's in there that most people aren't reading or seeing. Changes occur, now changes underway. Full risk rates will apply to property not previously insured, newly purchased, or to policy which is repurchased after a lapse. Premiums for older, pre-firm, or non-primary residents as a special flood hazard area will increase by 25% each year until they reflect the full risk rate beginning January 1st, 2013, and that has started. Later in 2013, premiums for pre-firm business properties, severe repetitive loss properties, 1 to 4 residences, and properties where claims payments exceed their fair market value will increase by 25% each year until they reflect the full risk rate. Normal rate revisions, which occur annually, and increases will include a 5% assessment to build a catastrophic reserve fund. Everybody's going to have at least a 5% plus your annual increase because they're charging 5% now annually to build a reserve fund. So even if you are not in a flood zone, and I've got one house that I voluntarily buy it, I'm in an X, that will go up 5% plus whatever the insurance company says the annual increase is. So they're estimating like 8% probably a year because you're going to have the 5% reserve fund plus your normal annual increase that you would typically have anyway. Late 2014, premiums for properties affected by map changes will increase over 5 years at a rate of 20% per year to reach full risk rates. A couple of things real quick. Pre-firm, which my house, I've got 2 like that on Tybee. Older houses received pre-firm rates because they were built. I'll use one of my examples, built in 1958 on slab. FEMA was organized in 1968. The first flood map for the islands in Chatham County was issued in 1978. So my house was built 10 years before FEMA existed and 20 years before there was a flood map. The government has always said you can't go in, or it'd be unjust to go in and tell that house that was built to codes, but there was no FEMA, no flood map. You can't go in and give them exorbitant insurance rates because at the time they built it, it was a code. Because that could cause someone to lose their property or have undue circumstances that really is not their fault. Well, now pre-firm is going away. So no matter when it was built, their response was, if it's pre-firm and you're below the BFE, you have 3 choices. Tear down your house and build it to current height, raise it up, which most of our houses on the coast at Tybee, the older properties, are concrete block. You can't raise concrete, they're cinder block. So that really doesn't work. But tear it down and build a new house, raise it in the air, or pay the exorbitant premiums. I mean, that's your 3 choices. I also have a loan on my houses at Tybee, and I don't know if they'd let me tear down their collateral or not. I haven't asked them yet, but I know it sounds good. One, I'd have to pay for both the old mortgage and the new mortgage to build it, but I'm not sure Wells Fargo would say, yeah, go ahead and tear down the house and build a new one, even though you owe on the mortgage. So that was the pre-firm. The other thing they're talking about in late 14, the premiums for properties affected by map changes, we also had grandfather. In Kill Hill right now, there's a terrible problem going on where between 2002 and 2005, I'm going too long, stop me. 2002 to 2005 in Kill Hill, they developed over, I think, 70 miles of coastal area. They built to county and government code, they built to FEMA regulations, they built to flood map regulations and codes. These are newer homes. Now we're not talking about old homes in the 50s, we're talking about newer homes that were built 2002 to 2005. While we were at conference and at that meeting, one of the gentlemen stood up, and I have not verified this information, so take it for face value from the realtor I heard it from. But those policies... That's your signal, sit down. Yeah. Those policies were, I believe, again, somewhere in the 1,500, 2,000 range, and one of the people had called while he was there, and their premium, they got a premium notice at $19,000 a year. So it's not just old homes, but the map had changed. Used to be grandfathered. If you were at an 80-10, again, you built your house at 10.5 feet, and the FEMA came in and remapped your area and changed it to the minimum flood elevation level of 12 feet. You'd be 1.5 feet under, but you built it to FEMA regulations. When you built it, you were grandfathered, and you could maintain the older rate, the rate you built it at. Well, they're phasing out the grandfather now too, which is a little bit of a different situation for all of us that live in coastal areas, even away from the coast, because that means any time that they change the flood maps and they raise that minimum level for your in the firm map, that you will not be grandfathered anymore, and you will pay whatever the rate is. So if today you're building a house, new construction, and it's an AE10 and you build it at 11, hopefully they don't come back and remap it that quick, but if 5-10 years from now they map it at 12 or 13 because they say something changes, then you'd be rated at 2 or 3 feet below the minimum level, and there is no grandfather to protect you, even though you built that code when you built it. Those people, right now, they're going to see rates increases at 20% per year until they hit full risk. The people that already were grandfathered, that built according to code, but subsequent maps became higher elevation than what they were at, they are losing their grandfather, and their rates are going up 20% a year over the next 5 years. Can I say just 2 more things real quick? A couple of interesting things I was just going to bring out. You'll see a lot of things that say myths about premiums. I'm going to read a couple of quotes. This is from the... Oh, wait, let me get this title for you. Speaking of... He's over the mitigation department because we can always mitigate, and I can't find his exact title. But what he said is, it's going to be a little painful, maybe a lot painful, if you're a realtor in an area with a lot of these kind of properties, he added. So he's over FEMA's mitigation. He says it's going to be a lot painful if you're a realtor in one of those areas. And one of the things is, we all get these little things about flood insurance in the mail if we have flood insurance. And I thought it was very interesting that according to FEMA, people outside of high-risk areas, which is what's really being hit hard right now, people outside of high-risk areas file over 20% of the national flood insurance premium claims and receive 1/3 of disaster assistance for flooding. But yet they're saying they're doing this because the coast is such a catastrophe, we're causing all these problems. But 20% of the people outside of the high-risk areas file the claims, 20% of the claims, and they used 1/3 of the money. So it really isn't matching up to a lot of people why this is happening. It sounds good, sounds like it's logical, but that's what it is. Thanks.
Thanks. Did y'all get all that? There'll be tranquilizers available. There will be shots of Patron to kill you at your expense. Okay, the way we're going to do this now is each panelist is going to have 3 minutes to make a statement. We'll start with the insurance, then after that, don't forget to send your cards up so we can have a question and answer. So I'm going to call on Rob Dunagan first to make up to 3 minutes of remarks.
But everything he said was certainly true. The one thing that I would say is we dig into this, and I don't think I'm an expert on it, but we've had to deal with it a whole lot more than we wanted to, and we will continue to have to, is it is going to affect all of us, some of us much greater, and I'm saying just as personal homeowners. You take even me, for example, living in Riverside, house built on a slab, pre-firm, meaning it was built before the flood rules, which in our area, firm is about 1984, give or take. But long story short, my premiums may be $7 grand right now. And it will go right under probably 20 grand, probably close into the 17 to 18 grand. So it's not a joking matter. They will get me if I do nothing, if I don't die or name change or sell my house or anything, they'll get my premium up over approximately 25% a year until they can get to the correct premium. And what they're saying is there's sort of 2 classes of folks in the flood insurance customers. Is we've got actuarialized, where basically they've gone in and calculated a rate based on what the house should be or what the property should be. And then you've got subsidized rates where they've gone in and said, okay, because of this or because of that, map change, year built, what have you, we're gonna subsidize you. Well, they're planning to get away from all of the subsidized properties and bring all of those properties up to an actual rate. And that's the black and white line of it. The most extreme cases that we'll probably deal with, and we're going to have to work together to work on this, is houses that are built on a slab, because there's just not a whole lot you can do with them. Okay, the houses that are elevated, again, we can go in and put flood vents, we can do different things, we can work with purchasers and homeowners, but it's going to not be fun is all I can say, and we're going to have to communicate early and often and work with each other. And I'm saying get your insurance agent out there, get your customer in front of the insurance agent to look at what the real situation is well before the sale, so it doesn't sit there and blow up in our face the last week. So, anything I can do to help?
The panel will be available shortly for questions, so send up your questions if you will. Next panelist, Fred McGinty, will talk about some additional insurance matters. Fred?
Thank you, Royce. One thing that the firm date for Glenn County is April 15th, 1985, which is the date that the flood rules became effective. So if the home was built before that date, it's a pre-firm home. If it was built on or after that date, it's post-firm. For the city of Brunswick, it was the date is June 19th, 1985. One thing Rob mentioned, he's correct in that they will get him in his home, but since that's his primary home, it doesn't affect him immediately, but it does affect the value of his home immediately, because anytime he were to try to sell it, the new buyer is going to be faced immediately with paying whatever the actuarial premiums are. And for y'all as realtors, the issue is for when you're dealing with a home that was built before the flood date, is to disclose to the buyer the fact that until October of 2013, they can buy, even if they bought the home today, they can buy a subsidized policy. But when that policy renews after October, excuse me, 2013, they're going to be subject to paying the actuarial rates, and they're going to have to get Bobby or somebody to do an elevation certificate, and they're going to pay based on where their house is relative to where it should be on the flood map. To give you an extreme example of a local property, we saw one in McIntosh County recently that was had a contract to sell from a local bank, and it was 5 feet below the base flood in an A zone. The premium before, the subsidized premium for building only was about $2,000. The premium for building only under the new rates was $10,500. And if they wanted contents, it was $15,000 and some change. So that this was about a $300,000 house. The flood insurance premiums all of a sudden became equal to or greater than what their annual mortgage payment was, and obviously that buyer kind of lost interest. And that's the big issue, and it's again, it affects for pre-firm homes that are sold after July 6, 2012. So unfortunately, as Steve mentioned, somebody that bought a home last year after July, they got the subsidized rates, nobody knew there was any problem. After October 1 of this year, when they get their flood renewal, it's going to be a surprise. And that's pretty much it in a nutshell.
Right.
Okay, from a surveying standpoint, would you come up, please, Bobby, and make some remarks?
Good morning, and thank you for letting me come here today. I'd like to recognize I have two partners here, Gary Neville and Teeple here. Y'all, so we're here to help answer questions, not just up from the panel here. Let me first expel the myth that the National Surveying Lobby did not propose this bill. And we're happy to answer any questions. There's going to be a lot we're willing to work through. I was asked a question earlier that I might speak to. It's my understanding Glenn County is the only coastal county that doesn't have a plus rating on the BFE. So in all the other coastal counties, let's say your requirement was 12 foot, they would be a minimum of 13 foot. I'm not sure, there may be more than that. There is a push for Glenn County to go to a plus rating. And what would that do to existing? I can't speak to that yet. I don't know. But I do feel like there's pressure from outside sources for Glenn County to go to at least a +1 rating. So thank y'all for letting us come. We'll help work with you. Thanks.
Bobby, thanks. I have a question that, since the state president is here, to ask her. It says, will the new risk premiums amount have to be disclosed in the listing to new potential buyers who will provide those estimates?
My answer to that question, and as not only state president, but as a broker, would be yes. And I would like to say at this point that the Georgia Association of REALTORS Forms Committee are developing a form, a flood insurance disclosure form to go in our forms packages, and we're looking at that very quickly. Also, we will be having a meeting or a conference call meeting on June the 18th with neighboring states or other states affected by this to potentially form a coalition to see what we can do collectively to look more into these problems. Thank you.
Thanks, Robin. Okay, first question has to do with insurance, and I'll start with Rob on this one. It says, please discuss differences in cost/availability of FEMA coverage for flood on primary versus second or investment property. Why are rates so different?
Why are the rates different? I'm going to refer that to Brad, the actuarial with the flood for the federal government. But long story short, they're the first person or the first group that they're already, as of January of last year or this year, that they've already started hitting with a 25% increase is secondary homeowners. So if you're a secondary homeowners in a pre-firm area, they're going to get your rate up as quick as they possibly can. The primary homeowners flood insurance, for example, on mine, as long as I don't sell my house or do anything of that nature, they're still going to get their money from me, but just not at a 25%. It probably will end up, and I don't think it's an exact number yet, but somewhere around 15% is what they're saying. So why is it more expensive on a secondary homeowners? Long story short, because they can. I mean, it's because they can. I mean, that's about the best answer we would ever get. And I hope that answers the question. I mean, there's not a nice way to it. But the secondary homeowners are the real ones that I see that immediately. I mean, today, because we dealt with this early in the year, where customers going, "Whoa, what's going on? Why am I getting this? Am I supposed to fill out this form and truly say that this is my secondary house, and my rates are going to automatically go up 25%?" Well, unfortunately, you've got to be honest with them, so we make sure we get the claim paid. And yes, the premium went up 25%. So.
Okay, thanks, Rob. Remember this too. This does not only affect your listings and your sales. It affects those people who have rental property.
Right.
So guess who's going to get the bill for that? Is your tenants.
Right.
So keep in mind, this thing is far-reaching. Okay, I have another insurance question that I'll ask Fred. This question asks, how many discounts can you get by building higher than is required?
That's a good question, and as Royce alluded to step back a minute and answer his question about what happens if Glenn County decides to require new construction to be 1 foot above the base flood, what would happen to everybody else? In my opinion, it wouldn't affect the existing folks that meet the FEMA requirements. As long as FEMA doesn't raise the base flood, the fact that Glenn County raised the base flood to say you've got to build now new construction 1 foot above, it would only affect new construction. So the rates wouldn't change for everybody else. It was still at the FEMA mandated levels. And on this question, it's a good question from the standpoint of what we've been recommending to our clients that we're considering building and to our contractor clients is to consider raising above the base flood if you can economically, because for one thing, the maps could change at some point in the future, and they probably will. It may be 5 years, it may be 10 or 15 years, but at some point they're going to probably raise the base flood elevation. The environmentalists that are all screaming and hollering about sea level change and it ought to affect flood maps, and so I think it would be prudent to look at elevating your house above the requirement. If you go up more than a half a foot, you get credit for a whole foot. FEMA rounds off to the nearest foot, so if you're over a half a foot above, you get credit for being 1 foot above. If you're a half a foot below, you get charged for being 1 foot below. The rates drop dramatically as you go up above the base flood. My house is in an A zone, and I built up to put the garage underneath, and I'm 3 foot above, and my premium's $400 or $500.
Well, can I, on that question, is there a max
Yeah, I think it's either 3 or 4 foot is the maximum that they'll give you credit for, and I believe it's 4 or 5 foot is the maximum they'll charge you for. So you can be 9 foot below, but you're not going to pay any more than the person that's 4 or 5 foot below, which is still going to be a big number.
So you could be +1, +2, +3, +4, or -1, -2, -3, -4,
Right.
-5.
Okay, Bobby, this one is for you. Can you define base flood elevation for flood insurance qualification guidelines if looking at an elevation survey?
The base flood elevation is determined on our firm maps. So the surveyor determines your location, and even if you have a larger piece of property, you could have multiple zones. So we would have to assert, the surveyor would determine which zone you are, and then the base flood elevation is on that flood map. I'm not sure if that answers the question.
Okay.
How they came to that number, actually, there is a little science to it. There is an analysis they do, and recently they flew all the coastal counties with LiDAR, and it helped improve what the actual ground elevations, and then they do a computer model and run the different hurricane events. That helps determine whether you're in a velocity zone or in an AE zone.
You're aware of what will be considered something under what we think is the base for to designate the slab level as your base floor. One of the realtors I talked to recently said they were selling a house and they had sheetrock the staircase going from the slab up to the house. It was not converted like most people cheat, and we know they cheat and they buy it and it's built to code, and then they go and put a game room or something downstairs with a window unit, air conditioner, whatever, and that's not allowed, and they know that. But this particular person, it was parking underneath and storage, but they sheetrocked the staircase because they wanted to look prettier going upstairs, and that particular elevation certificate basically said the finished floor elevation was the slab unless they removed the sheetrock from the staircase. So they had to take the sheetrock off the staircase. So there's going to be some variances there probably, depending on, I guess, the surveyor possibly, or I don't know how that's going to work. But
Well, it is a complicated thing, and he's right. Dead giveaways or bathrooms in the bottom. Truth is, you're not supposed to put refrigerators or freezers down in the lower level. I've talked with the National Flood Processing Center several times, and they tell me, well, the rules never changed. And I said, well, the rules may have never changed, but by God, your interpretation of what those rules are sure has changed. So, yeah, you're right. It's going to depend on the surveyor and his interpretation of your actual construction.
Bobby, for your purpose, is the bottom of the floor the bottom of the joist, or where the actual floor sits?
It's the actual floor on AE zones. On DE zones, the bottom is the lowest horizontal structural member, which may not be the joist. It could be beams or girders or other things that support that all the way around. So it depends on which zone it is.
Well, Bobby, this is another one for you right quick. The seller has an elevation certificate from 1985 and checked the FEMA map recently. He says the house is at 12 feet and FEMA may use what it says, AE 12. Is it good enough to tell the buyer he will be okay?
No.
Okay.
In 2006, they changed the datum from NGVD 29 to NAVD 88. Changed it a foot, not precisely, but generally a foot. So it's not going to be indicative of the current flood. And the forms have changed. There's a lot more information required of the certificate. The insurance agents need that information to properly issue flood insurance.
And again, just because that elevation certificate in '86 or whatever it was, that surveyor said that it met the requirement, doesn't mean the surveyor that goes out now for the renewal or for the closing isn't going to say that their refrigerator, their freezer, their sheetrock on their staircase doesn't put them at the ground level and throws them out. As realtors, we better not be guaranteeing anything or we're liable. So I think we leave it up to the insurance agents and the surveyors, and we just deal with the aftermath, unless we're stupid. That's all I can say.
I know there are a lot of other questions, but we have a time limit of 9:30 for this portion. Now, if the panel will stick around afterwards, could you stay a little while?
Sure.
Because we can do that, but we're going to go back to Vicki now for her wrap-up, and then we'll have an informal discussion, if you'd like, with the panel.